Assalamualaikum and hi everyone, I am Nawaal and Annuhaa from TBA114. So in this video, my group mates and I will be explaining our solution for each question. I will be starting with question 1. So under question 1, part 1, the question is construct the SYDM depreciation schedule for the machine. So first of all, we have to calculate the cost of asset, which includes the installation cost and transportation cost. Then we calculate the depreciation value and SYD. We then have to calculate the annual depreciation for each year. Once it's done, we plot the sum of years digit method depreciation schedule until we get the salvage value of 12,000 ringgit at the last year. For part 2, we are asked to calculate the total tax liability that the company has to pay. So since the selling price is bigger than the book value, we will get recaptured depreciation. So firstly, we have to calculate the value of recaptured depreciation by taking the selling price and subtracting it with the ending book value for year 2. Then we multiply it with the corporate tax. We also multiply the corporate tax with the earnings before tax. Then we total up the value of recaptured depreciation and earnings before tax, which will give us a total of 26,633 ringgit and 34 cents. In part B, we have to prepare the depreciation schedule for this asset by making adjustment to ensure the book value at the end of the life of the asset will be equal to the salvage value. So we have to calculate the value of cost of asset, depreciable value, and the DDBM rate. Next, we calculate the DDBM for year 1 to 5. Once we get the complete table, we have to calculate new depreciation values for the last 2 years and adjust their book values, which gives us a new book value of 80,080 ringgit for year 4 and 50,000 ringgit for year 5.
Assalamualaikum, my name is Faizatul Binti Saifuzzaman. I will present for question 2. For question 2A, QCQ Digital Corporation is planning to invest in one of the two projects, which are Project MCMC and Project Cyberjaya. Before making a decision, QCQ Digital Corporation must know about risk and return for both projects. After calculate the risk and return for both projects, the results show the expected return for the Project Cyberjaya is 6.7 and 6.25 for Project MCMC. While for standard variance, Project Cyberjaya is 3.27%, lower than Project MCMC with 9.26%. Last is coefficient variance. The Project Cyberjaya is 0.4881, while Project MCMC is 1.4816. Therefore, QCQ Digital should choose Project Cyberjaya because of the QCQ Digital is risk-averse company, and Project Cyberjaya has low standard deviation and coefficient of variance. Next, for question 2B. In this question, Tobishi Incorporation just released new educational tablet, which is selling price at 280 ringgit per unit. The company incurred a fixed operating cost of 560,000 ringgit per annum, and the variable cost is 120 ringgit. So the break-even point in quantity they hit is 3,500 units. And to achieve, in order to reach the break-even point, Tobishi Incorporation needs 980,000 ringgit. Lastly, if the company sells 2,000 units per annum, they can get a profit of 2,640,000 ringgit. That's all from me. Thank you.
Hi and Assalamualaikum. I am Affif Iman bin Badrol Zamri from TBA114 Now, I will continue by presenting question 3. This question is based on chapter 5. So, I have provided some steps to answer this question. So, there are 4 steps. And for the first step, you need to determine the breakpoint for each source of financing. Before that, you need to show the weight for each source as the weight that has been stated in the question. You must calculate the breakpoint. The breakpoint is the amount of total financing at which the cost of one of the component of total financing To calculate the breakpoint, the amount of each range need to divide with weight for each source of financing. Next, for the second step, you need to calculate the weight average of the cost of capital. Then, you need to construct schedule by arranging the range of total new financing, which is the first column according to the breakpoint. It is start from 0 to the first breakpoint of 750,000 ringgit Malaysia. Next, for the third step, you need to construct the weight marginal cost of capital WMCC and investment opportunity IOS schedule. Before that, you need to arrange the investment opportunity, which is cumulative as in the table on the presentation from the high to the lowest return. To get the answer of accumulated investment, and in other words, which is cumulative investment, like on the table, you need to plus the amount of investment with the amount of cumulative investment before. As you can see, the amount of investment B plus the amount of cumulative investment A, you will get the amount of cumulative investment B. You need to do this calculation until the last amount of investment in the table. And the last step, which is the fourth step, you need to choose which project should the company accept. You need to justify your answer as question 3D asks you to do so. Thank you.
Hi and Assalamualaikum. I am wishing you have a wonderful day ahead. Okay, my name is Aqil bin Zaidi. I am from group TBA114 and I would like to briefly explain about question 4 given by Sir Hanif for our group simulation assignment. In simple words, this question is about Raya Berhad is planning to raise an additional of 1.2 million ringgit capital in order to finance a new project. Before we continue answering the questions, I would like to list down first the information given on the questions so that it will be easier for us to answer. Okay, given is about the present capital structure of Raya Berhad. This organization recorded have a debt value of 800,000 ringgit with 6% of interest rates. There are no preferred stocks, there are no common stock given. With these information given, we can conclude the present value for debt value section is 48,000 ringgit. We can get this figure by take the debt outstanding value given and multiply by 0.06 interest. Then present value for common stock section is 50,000 based on the questions. Okay, then we have two alternatives for the company to get the target. Okay, in order to get alternative one present value, we must use the same method as I mentioned just now. Okay, for alternative one, the present value of debt is 33,000 ringgit with 5,000 preferred stock and 100,000 common stock. But this figure must add on the present value we calculated in the first place in order to get to answer the questions. The latest present value for alternative 1 is 81,000 ringgit debt value with 5,000 preferred stock and 150,000 common stocks. And for alternative 2 again, we need to apply the same method to get the latest present value. Okay, then we can finally answer the first questions, which is we need to get the EBIT in the difference level associated with two capital structures. Okay, in this case, we need to use the EPS formula. Okay, the formula is like in bracket, EBIT need to minus by the interest, which the debt value in the latest present value for each alternative. Okay, the answer need to multiply by 1 minus by tax rate that given in the questions, then need to minus by dividend preferred stock. Okay, the answer must be divided by the common stock. Figures that we are going to use is in the latest present value for each alternative. Okay, to get the EBIT value, we need to use the simultaneous equations, which is EPS structure alternative 1 equal to EPS structure alternative 2. And using the formula, we just insert the figure we calculated before into the formula. So the answer for questions A is we will get 171,928 points and 57 cents. Okay, for questions B, we need to use the same formula as before, but this time we need to replace the EBIT value with lower end, which is 100,000, and higher end, which is 300,000 for both alternative 1 and 2. Then in final part, to answer the questions, we will get the lower end, EPS, and higher end for alternative 1 and alternative 2. Okay, moving on to the question C, using the answer answer we earned from questions B just now, we just need to plot into the graph. As we can see, the point of indifference is 0.39 as both line crosses. Okay, the last question is about Raya Berhad. Expect its EBIT to be 600,000 and which alternative should be accepted by the firm. Okay, again, we need to use the EPS formula, but this time we need to replace the EBIT value with 600,000 for both structure and differentiate which value is the best for the company. Okay, for EPS structure 1, alternative 1, we get 2.39 ringgit, and for EPS structure 2, alternative 2, we get 6.38 ringgit. So Raya Berhad need to accept EPS structure 2, alternative 2, as it has the higher value, since investor will pay more for a company's share if they think the company has higher profit relative to its share prices.
Hi, my name is Khairul Zhafri and I will be presenting question 5. In this question, Ideal Berhad will be referred to as AC, which is the acquiring company, and Fitri Berhad will be referred to as TC, which is target company. For question A1, we need to calculate the exchange ratio based on the EPS. The formula is EPS TC divided by EPS AC. The answer is 0.9. For question A2, we need to calculate the exchange ratio based on the MPS. The formula is MPS TC divided by MPS AC, and we will get 0.45 as the answer. Next, we need to calculate the purchase price of Fitri Berhad for question C1. The formula to find the purchase price is MPS AC times bracket ER times NOSTC bracket. The answer is 2,160,000 ringgit. In question C2, we need to find the post-merger EPS for both companies. To find EPS AC, the formula is NIAC plus NITC divided by NOSAC plus NOSTC times ER, and we will get 2 ringgit and 95 cents as the answer. Next, the formula to find EPS TC is the post-merger EPS AC times ER, and we will get 1 ringgit and 33 cents as the answer. For question C3, we will need to prepare a post-merger balance sheet. Before that, we need to calculate the NOSTC company receipt, new goodwill, common stock, additional share premium, and the share premium post-merger first in order to balance out the balance sheet. The balance sheet is balanced with a value of 5,660,000 ringgit.